All right, we have been speaking about the IT sector, and the first set of IT earnings has really largely met the lowered expectations. While HCL Tech really retained its guidance and TCS really added to the deal wins, AI execution, deal momentum and demand trends really remain the key monitorables in this particular sector. Before we get more insights on how to play this sector now and what is the larger overview, Jasmeet, our in-house expert of IT, gets us all the details and summation of what's really transpired so far in this earnings season. Tell us, Jasmeet.
Well, Nisha, thank you for that. For the Indian IT, this has been a roller coaster year, and where Nifty IT is down about 20 to 25% on Y20 basis. Now, when we look at the earnings season, we're seeing a churn in the overall IT space, and the results what we have seen so far of TCS, HCL Tech and LTM, they have been in line in terms of the estimate. Now, for something like a TCS, the numbers have come in line, where we also see a good deal momentum for the company, and also company was added recently by Kotak into the model portfolio as well. And since then, we are seeing a good momentum in the stock as well. Now, when we look at HCL Tech, the company has retained its FY26 guidance, where a lot of street was divided, and they were expecting the HCL Tech might cut its guidance as Accenture has cut on the back of the slowdown, but HCL Tech has maintained its guidance, and also the overall valuation perspective, HCL Tech is in line with what TCS and Infosys are, and it's slightly expensive compared to TCS and Infosys. Now, when we look at LTM, while LTM becomes the third company in the top, fourth company actually in the top 10 IT space, with Nifty IT space, where they have come out and declared the AI revenue of $150 million. When you compare LTM's revenue with TCS or HCL Tech, LTM's currently contribute roughly 12% to the quarterly revenue, which is higher compared to TCS and HCL Tech. Well, apart from that, today we have also seen ER&D stocks reporting their earnings like Tata Elxsi and LTTS. For Tata Elxsi, the overall OEMs and European expenditure has been an overhang, given they're seeing a client slowdown, and the stock is about 5%. On the other hand, for LTTS, being in a similar space, we have seen the stock gain momentum as it was a turnaround quarter for the company. And in Q4, we had seen LTTS had moved away from the low margin projects, and in this quarter, we are seeing a turnaround where the mobility segment, the biggest segment for LTTS, has also gained momentum, so as the overall European chain. But there is still slight pressure the company is seeing towards the transportation and the OEM side, but as of now it's a wait and watch. Apart from that, lastly on the valuation aspect, the current IT valuations are anywhere between 13 to 14 times, which are cheaper when you look at over a decade or lower than 10-year PE valuation, but they still remain a little expensive compared to Accenture or Cognizant international players, and they have been always slightly expensive. And yesterday we had also seen IBM report its overall earnings, which was a miss in terms of the estimates, but the overall cross hit for Indian IT was negligible, given that IBM had seen an impact on the back of that infra spend. But most of the Indian IT works in consulting, and the consulting business for IBM has stayed resilient and has also grown in the Q2.
That's right, Jasmeet. That's an important point to make. And yes, thanks for summing up an exhaustive research. Now, Sandip Agarwal, the fund manager and co-founder at Sowilo Investment Manager, joins in now. Sandip, always a pleasure to get chatting with you, and a good day today. Many news points you have. You are enriched with the data coming in from a few of the IT companies already, giving you a view of the entire picture for this earnings season. And IBM also making a big announcement which really impacted our stocks and our ADR. Now, Sandip, the AI budget shift really hurts the legacy businesses. This is not new to us. We have been talking about the AI shift for a while. What is it that's really hurting the Indian companies, and how much of the cognizance will you put from IBM commentary on the Indian IT services sector?
Hi, good afternoon, and thanks for having me on the show. So, right now what is happening that everyone knows about AI, and no one is talking about IT services. So I think that is the biggest challenge so whatever is happening in the US market, for example, the way Accenture has been thrashed, Cognizant has been thrashed, and, resultant in India also, everyone is trying to go underweight or reducing position. We have been seeing this for last maybe 4, 5, 6 months. And a lot of money has been lost in the sector. Honestly, the index is down 50%. And so the challenge, I will tell you, what I see in most of the cases is that almost everyone who is invested in IT or who wants to be invested in Indian IT, they have confused disruption and cycle as disruption cycle. So they've combined two different things. One is disruption and one is cycle into one, and that is leading to all the confusion. So in my view, is there a disruption? Yes, there is a disruption, and we have seen disruption in IT every 5-7 years. We have seen last 20 years 3 disruptions. but cycle is different. So in every disruption, the cycle is same in the, and then we and then we and then we redeploy our people there, adopt the disruption, adopt the disruption, adopt the disruption, deploy our people there. So we are the last leg of beneficiary. So that cycle remains same. Unfortunately, everyone who is invested in the market today, they have seen same pattern playing out, that the disruptor gets benefited and we get massively negatively impacted in the initial phase of disruption, and we massively benefit at the fag end of the disruption. But unfortunately, still, despite seeing it so many times, people are not believing it. They, every time when disruption comes, they say that this time it is different, and this time our IT industry will be completely destroyed, which is
All
not,
right.
which has not happened.
So
I have,
Sandeep, to a large extent, and let me intervene there, I got your point, and to a large extent, this particular earnings season, almost all the IT companies have given their revenue and the contribution coming in from the AI shift. It's already showing up on their balance sheet. And how do you read into this? Also, now the race has shifted because of the IT services, the legacy business, all the levers being templated, the capacity of each of the companies well discovered. Don't you think the focus of new upgrades or downgrades have shifted towards the AI business and how well they are really creating that business? Like, for example, LTM has over 12% contribution in terms of revenue. Of course, the base is smaller than TCS, but TCS has 8% coming in from the AI revenue. How do you read into these new matrices? And my second point to this, which we can deliberate on also, is the outcome-based revenue model. How disruptive is it, and how will it change the pecking order as well as the potential for each of the companies? How do you see this?
so the right way to look at the very important metrics which most of these companies are reporting is the AI revenue as a percentage. So let's say, for example, LTM says that they have 12%. They have reached 12% of the quarterly revenue in AI. So the right way to do the maths is that, if 12% is, let's say, 100, then and it has come, let's say, at 30% discount. So what would have been the total number, right? And that is the gap which these companies have also filled. So to arrive at what was the actual non-disrupted or steady state growth, that you can arrive by doing that maths. And when you do that maths, honestly, you will be surprised that all these companies have actually grown at 12 to 14%. And because they have lost in the renewal, which has come in the AI side, 30%, we all know that AI is at least 30% more efficient in terms of effort. So they obviously would have negotiated 30% lower. So if they would have negotiated 30% lower and still they are at, let's say, 12% of the revenue, which means the total growth would have been in the range of 12 to 14%, which is reflecting as 0%. So that is very important point for me, because best of my understanding, the maths we are doing, we are at the fag end of the deflation of the efforts. So I think that maybe this quarter and maximum September quarter is where all the deflation will be accounted for, which means that whatever you grow, that whatever 10-12% you grow, it starts reflecting. Now, I am not saying that the large cap companies will grow at 10-12%. I think we are a matured sector. So 6-7% growth will start showing up from December quarter is my call. And if that happens this time, because there are no additional cost and it is a very efficient model, you will see a much higher PAT growth. So this sector is moving into a direction where 6-7% dollar revenue growth and 12-13% PAT growth and a cumulative EPS growth, which also has an impact of buyback, should be 45 to 70% for different companies for over next 3 years cumulatively, which means the CAGR of EPS has to be 12 to 18%, which is a very good, phenomenal CAGR. Even without any re-rating, that is the kind of return you should make.
And so many takeaways from what you said. But Sandeep, today it's a mixed bag when we look at the IT sector. Some of the stocks are still gaining in momentum, like Tech Mahindra, Coforge, which made a big acquisition towards the AI thrust. HCL Tech, which was down yesterday, is now seeing some buying at the lower level. And the other companies are really a drag. So a little bit of impact of IBM, not across the sector. Now, I want to understand one particular aspect. Looking at the AI attempts, do you have a segmented list of the winners and losers in terms of the new order of the AI thrust for the IT services pack, which are part of the IT index?
No, it is very simple. So, you don't have to do any research on that. It is there. Data is there. You have to just do the calculation. So basically, all these companies are now under pressure to report their AI revenues, and all the results which have come, most of them have given the AI revenues. So leave aside the ER&D companies where I have still negative opinion. So just to give you a flashback, 15 months back, I was of the view that IT services should fall by 50% and ER&D should fall by 70%. Now, IT services have fallen by 40-50% on an average. ER&D still has fallen only 45-50%. So we have another 20% correction which should happen in ER&D, because I firmly believe that maximum loss of uh, AI disruption is going to be in the ER&D space, because that is where you are using lots and lots of data for research. So I think still 20% more downside in ER&D companies will be there. So I'm not comparing them here. But what I'm trying to say is that that is the metrics to monitor. So if most of the companies are at 12-13% AI revenues, it means that large part of deflation is behind. So in next, I think 1 or 2 quarters, you will see ramping up. Now, which company will do better or not, we will know as the data comes, because every quarter they are catching up, trying to retrain their workforce. See, it is not only that you will get the revenue just like that. You have to create the ecosystem. You need the talent. I will tell you, today AI talent is available at 3 to 4 times more cost than the normal talent. So what you are doing, you cannot afford that talent. So you are taking very small quantity of that talent. You are training your existing talent so that you can normalize the cost. And that is the reason the catch up in AI revenue as a percentage of overall revenue is also low. So please understand that these companies, which the numbers which they are reporting, is not that they are able to generate only this much AI revenue. Problem is the supply chain. There are not so many talent who can come and deliver, and they are very expensive right now. So I
That's
think in
right,
next
Sandeep. Yes.
this will rationalize.
Yes, and very rightly mentioned that the skill set, the talent, and the acumen, capability is the biggest challenge right now. And that's why you've seen some of the companies really go in the path of collaboration, alliances, and M&A. We have spoken about Coforge, HCL, TCS have also made some efforts in this direction. And also recently, HCL Tech has invested in Sarvam AI. How do you see this particular combination really going forward? And in terms of your last bit of outlook for the IT services sector, at least for next 2-3 quarters, how do you see it?
No, so collaboration is the only way, because we are not into the first layer. So the first layer is the hardware, which is the NVIDIAs and AMDs. Then foundational layer where you have Grok, Gemini, and all that. We are not there. So we are into the services. So as soon as you will see continuous ramp up in enterprise AI, implementation of enterprise AI. When that happens, then you will need a lot of Indian IT services to help them with that. And I think this collaboration will train your workforce much quicker than otherwise. So I think we are in the right path. On Outlook, I have clearly said that next 3 years I see 45 to 70% return in the sector, X of ER&D, and I stand by that. And I feel that markets are generally very smart. As soon as they start seeing recovery, that 45-70% may come much earlier than 3 years. So while the EPS benefit may come in 3 years, the stock benefit may come in 6 to 9 months or 12 months. So I don't know when it will happen. Very hard to call that. But I am very positive. I think that X of ER&D, everything will do phenomenally well from here.
All right, very important takeaway. And in 3 years, about 70%, upside, and may be baked in much earlier as the recovery is seen. That's the big highlight, Sandeep. Always a pleasure to get your expert opinion on the sector. Thank you so much for joining in. All right, let's take it across to other